Those downside protection ETFs that promise safety, here's the truth. They cap your upside, only fully protect if you buy at the right moment, and often trail a basic stock, global bond, gold, and utility stock index mix over time. In the next several minutes, you'll learn what those actually do and don't do, why the 7% cap is a bigger problem than it seems, and a simpler path most investors should use instead. Hi, my name is Tommy Cloud. I'm founder of Third Act Retirement Planning. It's a wealth management firm I started in 2000. If you want to join our community of people seeking to steward their wealth wisely, please consider subscribing. We'd love to have you with us. All right, so let's jump right in here. What these ETFs actually do. These funds use options like collars to limit losses and cap gains. That sounds safe, but it comes with rules and trade-offs. The quote, protection only fully works if you buy at the very start of the fund's 1-year options period. Now, if you buy mid, your protection level and potential return change, sometimes a lot. Your value can still go up and down during the year. The protection is defined between the start date and the end date, not day to day. Why does the 7% cap actually? This is a question I want to address. Upside is typically capped around 7% a year. This is a very poor cap, and it is what kills long-term returns. We have other products that are registered index-linked annuities and structured notes that have full participation, usually in stock market gains or whatever the underlying index is, utility stocks, gold, whatever it may be, even cryptocurrency. And so 7% is not good. And in many positive 1-year periods, that cap means you miss out on much of the underlying index's market gains. So you often will lag equities or stocks in this particular case. In flat or slightly down markets after fees, you can end up with flat or negative real returns. So you're paying more for a result that can trail simple treasuries or CDs. I think that's ridiculous. But what to do instead? This is just simple and effective. For long-term goals, a basic mix of global stocks, gold, utility stocks, and global bonds, and depending on your net worth, some real estate, has historically done the job far better than these products because you keep more of the upside without complex rules and caps. And the downside's limited because of the non-correlation of the assets that you hold. In other words, when stocks drop 40%, maybe gold or utility stocks are only down a little bit or up. And if you're a qualified purchaser or accredited investor, you're going to want to look into adding some private equity, private credit, private real assets, and hedge funds. You even might want to look at some cryptocurrencies as your net worth goes up and your investment portfolio goes up. And crypto can be for investors any amount now that they've made these ETFs that you can buy that invest in Bitcoin. So yes, a global stock, global bond, gold, utility stock correlations can change, and sometimes they fall together. That's real. Even a global stock, gold, global bond, utility stocks mix remains a cheaper core than a capped, timing-sensitive product. Where might these ETFs fit? I don't see any need to use them the way they're making them. The caps are pathetic, and especially when you have products like structured notes and registered index-linked annuities that work well for investors by providing protection and usually 100% participation in the underlying index with little or no fees. I have no need for these type of ETFs, and I don't recommend them to our clients. If you're considering one of these ETFs, check the exact start date of the option cycle and where the fund is today. Don't buy blind mid-cycle. Compare the capped upside and fees to plain alternatives like treasuries, CDs, or a bond fund. Ask, am I actually getting more? And for the bulk of your plan, stick with a clear global stock, global bond, gold, utility stock allocation and revisit it on a schedule. Keep it simple and disciplined. And if you want to throw in some cryptocurrency, you could do that too. It just varies for each investor. Side protection ETFs can feel safe, but they come with caps, timing rules, and higher cost. They often underperform a simple stock bond mix with gold and utility stocks as well in the long run, and they may even lag safe alternatives in flat markets. Keep your core plan's simple. You can do all the things I've mentioned in here using ETFs or mutual funds, low-cost ones. I don't see any need for them. I'm always looking to serve you better. Let me know in the comments what topics you'd like me to cover next. If you want help building a resilient plan or talk more about these downside protection ETFs, apply for a sudden wealth planning session using the link, or you can take the quiz, How Much Do I Need for Retirement, and see where you stand. And that link is in the description as well. Otherwise, we'll see you on the next edition of the Sudden Wealth Stewardship channel.